Good day, fellow investors. I wanted to take a day of research. I hope you'll enjoy the two videos I make. And today I want to discuss a topic that is extremely important, but extremely under-discussed. The current mania in the news is about inflation because, of course, inflation is going higher and higher. A few months ago the topic was China, before that the topic was deflation, and constantly through those topics there is always this. This is the dopamine of stock market investing. Like social media, for many people, investors have stock prices going up and down. And even when the great Warren Buffett speaks, even then we see constantly the numbers there. And this was 2 years ago, and the topic then was the trade war. I really want to discuss here a strategy that always works. Something that can clear out the market's noise for you. Something simple, but in my experience, which is now almost 20 years of investing, for me it has always worked, which requires simplifying things and bringing down it to 4 concepts that I really think will help you increase your long-term returns. We are all here about not to get entertained by the news. If you are, then you are on the wrong investing path. We are here to maximize our investment returns and minimizing the risk over our life investing cycle. That's investing for me. That's what I want to emphasize, and also on this channel. That's the fundamental of this investing channel. The 4 concepts I want to discuss are investing essentials. What are the bare essentials of an investment? Essentials that you can focus on so that everything else is irrelevant. It's just noise, it's a waste of time. If you find those fundamentals, those essentials, everything becomes easy. Of course, when you find those, you have to buy things at a fair price. What is a fair price? That's again easy. What's a fair price to you? But of course, you have to keep in mind volatility and market cycles. And that's something that derives from the noise, from the situation in the markets. But again, if you focus on fundamentals, everything is again much easier. If you enjoyed this video, please long-term that like button, and let's immediately start. Now, what are investment essentials? I would define investment essentials as something you are relatively certain about. As Warren Buffett says, relatively certain, you have a 90% conviction that it will happen, and then where value investing comes in, margin of safety. If the 10% materializes, you still have a margin of safety, which means that even the worst case 10% chance scenario is still okay from an investment perspective. And if you find such, if you look, you will find, when you find such investments, then you know, okay, these are the essentials of this investment, which means these will be my returns, with the normal ups and downs related to the market, but over the long terms, these essentials prevail. I'll explain that in an example in a few seconds. Further, these essentials create value. Value which is tangible, not money printing where everybody thinks that you are getting rich, but you are not getting rich because inflation. Real tangible value that gives you purchasing power in the future through the business, through dividends, something that, okay, this created value for me. It's simple, it's in plain sight. Can be a dividend, can be rental income from a building, something that you're doing. So it is there, everyone's seeing it, and then it depends also on the fair price you're paying for it. 2 examples: if you own a business, if it's not listed, the only thing you get from that business is the dividend. That's about it. So what are the current dividends? And as we discussed in the intrinsic value video, if we can project future dividends with relative certainty, then we know the value of that investment. That is it. The future cash flows that will be delivered to us gives us the intrinsic value. To simplify even more, when it comes to real estate, of course, real estate prices go up and down, leverage, everything. But if you just own something, a good property in a good neighborhood, you can be pretty certain over your long-term rental yield. Then you can increase that with inflation or not, but if you focus just on the rental yield, that's it. So I have an apartment of $1 million, the rental yield is, I don't know, 50,000, that's 5% per year, and that's about it. So the 50,000 are the core essential return that investment is creating for you. If we take the S&P 500 dividend yield as an example, we have a dividend of 1.27%, which is one of the lowest in history, but this is the essential bare investment return the index is currently offering. And if we calculate things, we have the S&P 500 4,600 points. If we look at the dividend, 1.27% in points is 59.04. This is the value of the dividend the S&P 500 is currently delivering. And this is the bare essential of the S&P 500 of the index. If you are an investor and the stock market closes over the next 20 years, you can count on getting 1.27% yield on your money with the yearly likely 4 or 5% increases coming from what the businesses do for growth, for inflation, from buybacks, etc. And that's about it. That is the real value the index delivers. When it comes to investing, you have to see, okay, will that essential return the index is creating lead me to my investment goals? 1.27 yield with 10% inflation currently will eat up your purchasing power by 9% per year, so you end up broke and miserable in 10 years. Sven, what are you talking about? Don't tell that to people. Sorry. So, unfortunately, very unlikely. It has worked great over time, but now this is the bare essential yield, which means that if you want to focus on investments, then you have to find investments that will give you an essential return that will lead you to your financial goals. So if I would have to personally determine what is my fair price for the S&P 500 index, let's say dividend growth of 5%, then as my minimum investment goal is 15%, I would need a dividend yield of 10% now or in the future plus 5% growth. So my fair value for the S&P 500 would be 59 times 10, that's 590 points. So back in February, March 2009, for me, the S&P 500 would have been fairly valued. This would all be overvalued because I had usually better, and I still have, especially now, much better. So you have to see how this 1.27% fits your goal. Perhaps at 3% it will be a fair value, perhaps at 5%. If interest rates go up, you might see it again, or it was the case just 5 years ago. So the fair value, the fair price to pay, depends on your requirements and your goals. Of course, there is always volatility. The S&P 500 did well over the last 20 years with a return of 7.5% per year, but you had 49% decline in the early 2000s, 57% decline with the financial crisis, and I can tell you that here, in this period, those holding the S&P 500 were not happy, were not in a happy place, and this was an ugly environment to hold things. And yes, now we're looking at this monetarily created boom in the markets, the greatest bull market in history, but this can happen again, and you have to be ready. And if you're focused on investment essentials, don't know, the dividend yields was much higher, the price earnings was lower here, so yes, it was a bargain, but we are now far from that, thus this is risky. Nevertheless, whatever investment you buy, you have to accept the volatility as a Given the current environment, we'll discuss more about the current environment tomorrow in a market overview where we'll apply this discussion. Of course, treasuries, if you look at the minimum yields there, those have negative real returns, so the essential return is actually zero. There will be crazy volatility, but crazy volatility will be anywhere. My focus is expect volatility, but if you focus on the bare essentials and you find them, and you find those that will lead you to your goals, then volatility is your friend. Actually, you welcome it because you can buy more on the cheap. Treasuries, 10-year treasury, what we are now, 1.5 yield, which is still negative real returns. And discussing the market, we have had 20 years of declining interest rates, and this is the only reason, the main reason why stock prices are up. If we go back to a period of 20 years where interest rates went up, and now we're talking about cycles, then the market's return will be pretty bad. And you can see here the correlation between interest rates and monthly S&P 500 returns. Of course, it's pretty good. When interest rates are higher, returns are much lower. To put this into perspective, in a period when interest rates were growing, there was a 17-year zero return, and the starting point here was much lower than where we are now compared to valuation. So if interest rates start to go up because of inflation, the real essential return from the market will get really ugly. Therefore, I urge people to look at those real returns. And now growth stocks are very expensive, but value is getting cheap relative to growth stocks, which means that there are pockets of the market where you can still find value. For example, also, the US is currently the most wanted market in the world, but other markets like emerging markets, and we'll discuss a little bit more about that tomorrow, still offer value, and it's up to you to find those returns that give you what you want. And when it comes to strategy, people think always that I need to beat everyone in this year, I need to own the best investment, I need to outperform. No, forget about it. You just need to find the vehicle that will lead you to your financial goals, year over year, cycle over cycle. And when you find that, then you are set. Then over the next 40 years, whether interest rates go up and down, you absolutely don't care, because you know that the essentials will lead you to your financial goals. I will put this into my next book. I have started writing a little bit. Also, the intrinsic value template will go in the book, and it's going to take me a year or two. But I'm looking forward to your comments on this to see whether something is not clearly explained. This is also part of my free stock market investing course. You can already pre-read it if you want it there. The link is in the description below. And I really want to ask you also your feedback if this is clear. This is the essence of what I do also on my stock market research platform, on my research, looking for those essentials, and this is what actually makes everything easy. Just to be a little bit more detailed here, if you look at the price-earnings ratios in the world, so if you go for lower, your likely long-term return will be higher, given everything else is the same. But also, if you look at the S&P 500, then you see that there are expensive businesses, so where these price-earnings ratios exploded, but there are also those relatively much cheaper businesses, as this is the dispersion. So 20% of the S&P 500 is cheaper than a price-earnings ratio of 12, I think this is, which means that's an 8, 9, 10% earnings yield. 8, 9, 10%, 20%, that's 100 stocks that are relatively cheap. Among those 100 stocks, if one can find 2 that fit one's investment portfolio, that's it. That's it for this year, for these 5 years. And so you build something on essentials. Tomorrow we'll discuss the market, JP Morgan's overview, so please subscribe for that. Check my research platform if you're interested in what I do for a living, which is investment research, my portfolios. The price is going up end of the year, so you can lock in the price forever. And also check other videos if you're interested. Thank you for watching, and I'll see you tomorrow.